Hello my fellow investors, and welcome back to another earnings report analysis as well as a quick stock analysis video, guys. This past week when it came to earnings was just absolutely crazy, especially Thursday and Friday. We had Apple, Amazon, Intel, McDonald's, Caterpillar all reporting, and some of them did really good while others did very bad. So I would actually like to cover, guys, in this video a couple of companies here that had earnings. I'm going to show you guys their earnings, go through them a little bit, and of course I will leave the link in the description to all of their earnings just so that way you guys can read it as well. But I want to go through all of them, guys, give you guys my opinion as well as do a very quick stock analysis and give you my projections as to what the company should be valued at. So with that said, let's get started with this analysis. And the first one, guys, that we're going to take a look at is none other than my baby, Intel Corporation. Guys, if you all remember last quarter, this company was just awful. They did awful when it came to pretty much everything, and they dropped from like $40 all the way down to like sub 30. However, as of Q3, things have changed drastically. In fact, on all three metrics, EPS normalized actual, EPS gap actual, and revenue, everything beat, guys. The EPS normalized actual beat by 26 cents. They actually got 59 cents. EPS gap actual beat by 12 cents. They got 25 cents. And the revenue, they did $15.34 billion, which was a beat by almost $30 million. Now, guys, this resulted in the share price going up a whopping 10.66% on Friday, which was just insane. And on top of that, guys, even post-market on Friday, they went up again almost 0.25%. However, though, as you can see here on the yearly graph, they're almost down more than 39.5%, and on the year to date, they're down 45.37%, 52-week ranges of $24.59 to $56.28. Now, looking at the earnings report, guys, obviously we just saw that based off of analyst estimates, they pretty much beat everywhere. However, their earnings report actually wasn't that good. Even though we did have a beat in everything, guys, the earnings report was still very bad, believe it or not. Anyways, we have here, guys, Intel's earnings report for the third quarter of 2022. Third quarter GAAP revenue of $15.3 billion was down 20% year over year, and non-GAAP revenue of $15.3 billion was down 15% year over year. So right then and there, guys, even though they did beat analyst estimates when it came to their revenue of $30 million, like they beat by $30 million, year over year, guys, their revenue was down over 20%, which is crazy. Third quarter results include GAAP restructuring charges of $664 million, reflecting an initial cost reduction action. The company's focus on driving $3 billion in cost reductions in 2023, growing to $8 billion to $10 billion in annualized cost reductions and efficiency gains by the end of 2025. Third quarter GAAP earnings per share was 25 cents and non-GAAP EPS was 59 cents. Listed Mobileye on the NASDAQ stock exchange this week. Okay, revising full year revenue guidance to $63 billion to $64 billion, reflecting continued macroeconomic headwinds. That last bullet point, guys, is very key because essentially they're saying that there's still economic headwinds ahead. And it's actually interesting because here in the CEO statements, he puts this out like perfectly. Like he doesn't pull back any punches. And I actually really like that. He pretty much just said, quote, "Despite the worsening economic conditions, we deliver solid results and made significant progress with our products and process executions during the quarter," said Pat Gelsinger, Intel CEO. "To position ourselves for this business cycle, we are aggressively addressing costs and driving efficiencies across the business to accelerate our IDM 2.0 flywheel for the digital future." Now the CFO also said a few words, pretty much just said, "As we usher in the next phase of the IDM 2.0, we are focused on embracing an internal foundry model to allow our manufacturing group and business units to be more agile, make better decisions, and establish a leadership cost structure," said David Zinsner, Intel CFO. "We remain committed to the strategy and long-term financial model communicated to our investors meeting." Yeah, guys, they are pretty much just being like, we have had tremendous headwinds, especially in the chip sector, guys. They're not pulling any punches. Things are going to get worse, but even with that, the fact that they beat analyst estimates, even though they're down year over year, made the stock price completely skyrocket. Now, I would actually like to take a look at some of these comparisons when it comes to 2021 and 2022, both Q3. Revenue, guys, we did see down 20%. 2021, guys, it was $19.2 billion. In 2022, it was $15.3 billion. Gross margin, 2021, it was 56%. 2022, it was 42.6%. It was down 13.4 percentage points. R&D and MG&A, 2021, it was $5.5 billion. 2022, it was $6 billion. That was actually up 10%. So they're doing a lot of investing when it comes to their R&D sector, which is actually really solid. Operating margin fell. In 2021, it was 27.2, while in 2022, it was negative 1.1. It was down 28.4%. The tax rate, 2021, it was 0.5%. Now it's 642%. Absolutely insane. Net income was down 85%. 2021, 6.8 billion, 2022, 1 billion, and lastly, the earnings per share in 2021, $1.67, in 2022, 25 cents. That's absolutely massive downturns all across the board, guys. But for the fourth quarter, guys, they're actually projecting some okay numbers, I guess you could say. Right here, we got the revenue between 14 to 15 billion, gross margin 41.4 billion, tax rate 40%, and an earnings loss per share of negative 10 cents. So that's actually fairly interesting because these are their projections, and we'll see what they do when it comes to their Q4 when those earnings report come out. But now, based off of that, guys, let's actually come over here and make some assumptions when it comes to discounted free cash flow. Ticker symbol of INTC, market cap of $119 billion, PE of 6.23, which is very tiny for a current share price, guys, of $29.07. Again, this did go up a whopping 10% on Friday, but even still, guys, we're fairly into the 52-week low when it comes to this number. Annual dividends of $1.46, which translates to a whopping 5% yield with a payout ratio of 50%, 6.26% 5-year CAGR, and 7 consecutive years of dividend growth. In regards to the amount of dividends being paid out every single year, this is $6 billion based off of their 5-year average free cash flow. This is now $8.4 billion, and as of last year's free cash flow, it is $3.6 billion. These payout ratios for the last year, it is 62.36%, a little bit high. However, for the 5-year average, it is way below my margin of 60%, and that is 41.78%. Looking at some fundamentals, guys, we got increasing net income of 107%, free cash flow a decrease of 6%. You can clearly see massive drop from 2 years ago to 1 year ago of 21 billion 2 years ago to $9.7 billion. That is an average free cash flow of 14.4%. Revenue, however, increased very consistently of almost 26%. Total assets minus the total liabilities, it is currently at almost $100 billion, which is really good. Average assets minus the average liabilities, it is almost $83 billion. Cash flow minus liabilities, however, it is going deeper and deeper in the red, mainly because their free cash flow is falling. Average cash flow minus the average liabilities, it is negative $48 billion. When it comes to their shares outstanding on the 5-year, it is a decrease of almost 12%. However, recently, guys, from 1 year to the other, so you can clearly see they did increase around 1.4% of shares. And lastly, they currently have $4.5 billion in cash and equivalents with an average of $4.3 billion. Now coming into discounted free cash flow, I'm going to make a revenue assumptions of -2, 0, and 2% for the low, medium, high assumption, and for the projected share buyback, -1, which means that they'll issue shares for the low assumption, 1% for the median, and 3% for the highest assumption. Guys, this puts me between the ranges of $20.72 to $24.90, not adjusting for debt. And adjusting for debt, it is $17.73 to $21.79. So rather recently, just a couple weeks ago, when this thing fell a significant amount, guys, we were essentially between the median and high assumption, but as it currently stands, it is very much overpriced based off of these assumptions. But all in all, guys, you can clearly see their earnings report wasn't that good, yet their share price did go up just because they beat analyst estimates. And now, guys, let's actually take a look at Apple's earnings, because Apple did have earnings, guys, and it was fairly interesting as well. Now, we have here, guys, a couple of points. We got Apple today announced financial results for its fiscal year 2022 fourth quarter ended September 24, 2022. The company posted a September quarter record revenue of $90.1 billion, up 8% year over year, and quarterly earnings per diluted share of $1.29, up 4% year over year. Annual revenue, $394.3 billion, was another 8% year over year. And annual earnings per diluted share was $6.11, up a whopping 9% year over year. Guys, I always say it, Apple's numbers are just absolutely crazy all around, so it's not surprising that they did this good this past quarter. Now, a couple points from the CEO. He pretty much just said, this quarter's result reflects Apple's commitment to our customers, to the pursuit of innovation, and to leaving the world better than we found it, said Tim Cook, Apple CEO. As we head into the holiday season with our most powerful lineup ever, we are leading with our values in every action we take and every decision we make. We are deeply committed to protecting the environment, to securing user privacy, to strengthening accessibility, and to create products and services that can unlock humanity's full creative potential. So as you can clearly see, they're putting out a very, very rosy guidance into the future, and the fact that they just beat pretty much from last year's every single earnings that they got, that was actually amazing. And even when it came to analysts, they beat by a decent amount as well. EPS non-GAAP, they beat by 2 cents, they did $1.29. EPS GAAP was also $1.29, was another beat by 2 cents. And the revenue was a beat, guys, by $1.37 billion. In fact, let's actually take a look at some of these numbers and compare it to last month. Now, we did see a couple of them already, but it's always nice to take a look at these. Now, we got total net sales, $90.15 billion. Last year, it was 83.36, guys. That's absolutely crazy. You can see the gross margin, 38.1. Last year, 35.2. Net income was 20.7, and then 2021, it was 20.55. So that one was actually, it was an increase, but it wasn't like a major increase. And when it came to the diluted shares, guys, 2021 it was $1.25, and this year it was $1.29. That is absolutely crazy. Now, what is a little bit concerning though is that when it comes to their total assets, guys, last year they had $351 billion. This year it went up to $352.7 billion. However, though, coming over here to the liabilities, guys, this was a massive increase. Last year it was $288 billion, and this year was $302.1 billion. So unfortunately, their liabilities are definitely increasing more than that of their assets. So obviously, seeing all those great numbers, guys, and on top of beating analyst estimates, Apple rose a whopping 7.6% on Friday alone, which was almost $11. And even post-market, they went another 0.07%. On the 1 year, guys, they're actually up 2.08%. On the year to date, however, they're still down 14.43%. 52-week ranges are $129 to $182, almost $183. Coming now into the calculator, we got the ticker symbol of AAPL, market cap of $2.5 trillion, with a PE of 25.48, so a little bit high, with a current share price, as we saw, of $155.74. Annual dividends per share of 92 cents per share, which ends up being a dividend yield of almost 0.6, payout ratio of 14.73, 5-year CAGR of 8.45, and 8 consecutive years of dividend growth. This annual dividends come out to be $14.7 billion being paid out in dividends every single year. And based off of their 5-year average free cash flow, guys, and their last year's free cash flow, they are just, oh my god, they just have so much money left. Off of their 5-year average free cash flow, they're still left with $65.5 billion. And as of last year's free cash flow, they still have $96.8 billion. These payout ratio, guys, are super tiny, 13.16 for the last year's free cash flow and 18.3 for the 5-year average. And of course, when it comes to their fundamentals, guys, it is just absolutely looking amazing. Increase in the 5-year, so you can clearly see, by 68%. Free cash flow is also an increase of 74% with an average of $80.2 billion, increasing revenue as well by almost 50%. Total assets minus total liabilities, however, is actually coming down, and we just saw their earnings report that it was coming down even more then. Granted, they're still in the positive as of today by around $50.7 billion. Average assets minus average liabilities, it is $71.2 billion. Cash flow minus liabilities, it is essentially remaining flat, and average cash flow minus the average liabilities, it is $190.9 billion. Shares outstanding, it is consistently decreasing year over year. On the 5-year, it is down 16.16, and on the previous to the current year, it is down almost 3%. And lastly, cash and equivalents, they currently hold $23.6 billion with an average of $32.5 billion. And of course, making some assumptions, low, medium, high, using a revenue growth of 2, 3, and 4%, and the projected share buyback of 5, 6, and 7%, guys. This puts me between the ranges of a target share price, not adjusting for debt, of $74.47 to $81.53. Adjusting for debt, however, this comes up massively to now $150.50, all the way up to $164.65. So at the current share price, guys, of $155 is telling me that we are between the low and median assumption over here, based off of my assumptions that I made up here. And guys, Apple is a company that it is essentially like the golden boy, the golden standard when it comes to every single stock. And the fact that you might have been able to buy this just a couple weeks ago at $129, and the discounted free cash was telling me that between $150 and $164 is a good price, you're probably sitting pretty right now if you just did that. All in all, Apple, amazing company. Not surprised with these earnings support, and I'm also not surprised that it went up that much. Alright guys, and now let's head over into the third company, and that is none other than Exxon Mobil. Oh my god, guys, this company had earnings and it was just crushing. Like, I'm talking about, oh my god, they did better than freaking Apple. It was crazy. So let's actually come over here to, guys, Seeking Alpha, and see that their normalized EPS actual, guys, was $4.45, which was a beat by a whopping 64 cents. EPS gap actual 62 cents, beat $4.68, and a revenue growth of $112.07 billion, which was a beat by a whopping $7.31 billion. Absolutely insane, guys. And let's actually come over here to the earnings report right now and read a few of this. We got here, earnings grew and cash flow from operation activity to $19.7 billion and $24.4 billion respectively. Guys, look at that absolute cash flow. Oh my god, $24.4 billion. A strong volume performance, including record refining volumes, rigorous cost control, and higher natural gas realizations more than offset lower crude realizations and weaker industry refining margins. Achieved best ever quarterly refining throughput in North America and highest global since 2008. That's kind of wearisome because we all know what happened in 2008. Delivered strong quarter oil and gas production, including record Permian production of nearly 560,000 oil equivalent barrels per day to better serve demand year on year. Total production increased by 50,000 oil equivalent barrels per day. Signed largest of its kind commercial agreement to capture and permanently store up to 2 million metric tons of CO2 emissions per year. Declared fourth quarter dividend, guys, of 91 cents per share, an increase of 3 cents per share, paying out $15 billion in aggregate for the year. So they just had such a great quarter, guys. It's absolutely crazy. Cash flow increased massively. So let's actually read what the CEO actually had to say on this. We got, quote, "Our strong third quarter results reflect the hard work of our people to invest in and build businesses critical to meeting the demand we see today," commented Darren Woods, Chairman and Chief Executive Officer. Quote, "We all understand how important our role is in producing the energy and products the world needs, and third quarter results reflect our commitment to that objective. The investments we made through the pandemic enabled us to increase production to address the needs of consumers. Rigorous cost controls and growth of higher margin petroleum and chemical products also contributed to earnings and cash flow growth in the quarter. At the same time, we're expanding our low carbon solutions business with the signing of the largest of its kind customer contract to capture and permanently store carbon dioxide, demonstrating our ability to offer competitive emission reduction services to large industrial customers around the world." So all of this, guys, was just absolutely amazing to hear, and I'm so actually surprised that he mentioned this part over here of the rigorous cost control and growth of higher margin petroleum and petroleum chemicals, because, well, guys, we all know that there's a lot of regulations on oil companies recently, and basically the amount of oil supplied to come down, therefore the price is shooting up, which we're all seeing at the pump. And now, guys, let's actually come over here to, of course, page 10 to see what these comparisons were to 2021. We got here total revenues, guys, and other income. 2022, $112.1 billion. Comparing this to 2021, $73.8 billion, guys. That is absolutely insane. Massive, massive increase. And looking at this, we also got the net income before taxes we got this year of 25.4 billion, and last year, guys, it was 9.6 billion dollars. Once again, a massive increase. And when it comes to their total assets, guys, they currently hold 370.2 billion dollars, and total liabilities, it is at 177.12 billion dollars. Comparing this to last year, we can see that they went from 339 billion dollars to 370 when it comes to their assets, and liabilities, they went from 163 to 177. So as you can clearly see, they are increasing their assets a lot more than they are their liabilities. And guys, because of all of these great numbers and just the fact that oil is in such short supply today, well, on Friday, guys, they rose nearly 3%, which ended up being $3.15. Even post-market, they went up a little bit of 0.03%. On the 1 year, guys, oil has just been crushing it, absolutely crushing it. Exxon Mobil leading the charge on the 1 year, up 72.13%. And on the year to date, 74.22%. 52-week ranges are $57.96 to $111.21. Coming into the discounted free cash flow, we got the ticker symbol of XOM, market cap of $461.4 billion, a PE of 12.09, and the current share price of $110.70. Annual dividends of $3.52, which ends up being 3.18% with a massive payout ratio. However, guys, I do believe that this is incorrect. After all, they did just increase their dividend amount per share. Right here, they have it at 88 cents. However, they've said that they were going to increase it to 91. So I think that's the reason why this is the case. But nonetheless, that's clearly incorrect. A 5-year CAGR of almost 3% and 19 consecutive years of dividend payment. And this $3.52 actually comes out to be, guys, $14.5 billion in dividends being paid out every single year. Based off of their 5-year average free cash flow, however, this is actually a negative $515.7 million. So unfortunately, based off of their 5-year average, they cannot cover this dividend. However, based off of their last year's free cash flow, guys, they're still left with $21.6 billion. That is an amazing payout ratio of 40.21%. However, on the 5-year average, it is almost 104%. Now, looking at these fundamentals, we got the net income up 17% on the 5-year, obviously slightly going down from 5 to 3 and went negative 2 years ago because oil went negative, but clearly they recovered fairly nicely. Free cash flow is also increasing except for 3 years ago and 2 years ago at 146% on the 5-year with $14 billion in average. Revenue was an increase of 17.63%. Assets minus liabilities, they currently hold $193 billion with an average assets minus an average liabilities of $187.5 billion. Cash flow minus liabilities currently at negative $127.2 billion. And this graph actually doesn't look too bad either, with an average cash flow minus an average liabilities of negative $145.5 billion. Shares outstanding decreasing on the 5-year of 2.85%. And from the previous year to the current year, it is also 2.85%. They did increase it from 2 years ago to 1 year ago, but then this year so far they have decreased it by 2.85%, as I just said. And when it comes to the cash and equivalents, guys, they currently hold $30.4 billion with an average of $8.48 billion. Now making some assumptions of low, median, high using revenue growths of 8, 10, and 12%, and a projected share buyback of 1, 2, and 3. This puts me between the ranges of $41 to $47.78, not adjusting for debt. And adjusting for debt, it actually comes up to $44.77 to $51.64. All in all, guys, Exxon Mobil had an amazing earnings, and by the looks of things, I believe oil will probably not go out of style anytime soon. And it just goes to show that even though people are definitely moving towards more green energy kind of things, oil is still in very high demand overall. Alright, and now guys, we come to the last company that I would like to take a look at the earnings report, and that is none other than my favorite oil company, Chevron Corporation. Guys, if y'all have seen my videos before, y'all should know that this is my biggest company and by far my best investment to date. I'm gonna put a picture of my gains when it comes to this company. This is the on the money weighted returns, so this is also taking into account dividends. As you can clearly see, I am up more than $10,000 overall on this company. One of my best companies so far. I have about 122 shares in them. Amazing. My cost basis is around like $100 or so. So let's actually see what the earnings report actually look like for Q3. And guys, coming to Seeking Alpha, we could see another beat pretty much across the board. EPS normalized actual $5.56, which was a beat by 64 cents. EPS gap actual $5.78, which was another beat by 91 cents, and the revenue came in at $66.64 billion, which was another beat by, look at this, $5.66 billion. So overall, guys, they beat on every single metric that analysts were looking at. So now let's actually take a look at these earnings report, guys, because this is very, very interesting. So we got here, Chevron announces third quarter results for 2022, reported earnings of $11.2 billion, adjusted of $10.8 billion. Cash flow from operations, guys, $15.3 billion, and free cash flow of $12.3 billion. I love when they put the free cash flow like metric right there. First thing is absolutely amazing. Shareholder distribution of $6.5 billion. Now we got here Chevron Corporation today reported earnings of $11.2 billion or $5.78 per share diluted for the third quarter of 2022, compared with $6.1 billion of which was $3.19 per share diluted in the third quarter 2021. Included in the current quarter were pension settlement costs of $177 million. Foreign currency effects increased margins by $624 million. Adjusted earnings of $10.8 billion or $5.56 per share diluted in the third quarter 2022, compared to $5.7 billion in earnings, which was $2.96 per share diluted in the third quarter of 2021. So overall, guys, they just completely crushed it. Now let's actually take a look at what they did when it came to their business segments. I love how they have it here split up between upstream and downstream. By the way, for all of those of you who don't know the oil sector too well, I do know a little bit of it because I did study it when I was in college, since I studied as a chemical engineer, so I know a little bit about this. But essentially, guys, upstream is them bringing the oil up from the ground, the crude oil up from the ground, and downstream it is essentially refining it. There's another one that's called midstream, and that is the transportation between upstream to downstream. That right there is called midstream, but not really that important, just mainly wanted to tell all of you guys just in case you didn't know. But as you can see right here, guys, the upstream 2022 $9.3 billion, 9.31 actually, 2021 $5.1 billion, guys. That is an absolute monster change. And on the downstream 2022 $2.53 billion, 2021 $1.31 billion, total of 11.23 for 2022, and for 2021 $6.11 billion. They nearly doubled their earnings overall from upstream and downstream in just 1 year, which was insane. Now looking at what the CEO had to say here, guys, he's pretty much just said, we delivered another quarter of strong financial performance with return on capital employed of 25%, said Mike Wirth, Chevron's chairman and CEO. At the same time, we're increasing investments and growing energy supplies, with our Permian production reaching another quarterly record. During the quarter, the company paid dividends of $2.7 billion, 6% higher per share than the third quarter of 2021. So in 1 year, guys, essentially from Q3 of 2021 to Q3 of 2022, Chevron gave you an increase in your income, assuming that you have them, of 6%, which is really, really good. Increased investments by over 50% from the last year, paid down debt for the 6th consecutive quarter, and repurchased, guys, 3.75 billion shares, more than 1% of shares outstanding. I love the way that they just say this, because they essentially hit on every single point that I love to see, and I love that. Don't have to go looking for it. The company's third quarter Permian Basin unconventional production totaled over 700,000 barrels of oil equivalent per day, up over 12% from the last year's quarter. We've also taken important steps to position both our traditional and new energy businesses to help meet the world's growing demand for our products, Wirth concluded. So guys, they just absolutely crushed it. Really, really rosy numbers, and on top of that, very rosy forward guidance. And for all of those great numbers, guys, Chevron rose massively. On Friday, they were up 1.17%, which ended up being $2.08. And even post-market, they did go up a little bit, around 0.01%, around 2 cents, to a final price of $180. Take a look at this, guys. Obviously, just like Exxon Mobil, the oil sector and the energy sector has just been bonkers recently. Take a look at this in the 1 year. Chevron, 59.11%. Year to date, 50.91%. Take a look at these ranges, guys. 52 week of $182.86, which we are essentially there. We are at pretty much all-time highs already. And the 52 week low of $110.73. Now remember, I was buying this at like the $100 mark. So again, I'm up $10,000 on this company alone. And actually, if I would have listened to my friend, which he's like an oil tycoon, like I'm not saying that literally, but like the guy knows a lot about oil. He's a really big oil fan. Hopefully you're watching this, Rich. Shout out to you. He was telling me to buy this when oil went negative and Chevron fell to around like the $57, $60 mark. And I did not do it because I was afraid. So if I would have listened to him, oh my God, I would be up like $25,000 today if I would have bought at this low. But nonetheless, guys, coming over here to the discounted free cash flow, we got the ticker of CVX, market cap of $352.3 billion and a PE of 12.02, current share price of technically $180, annual dividends per share of $5.68, which, guys, results in a dividend yield of 3.16%, payout ratio of 7.75, and a 5-year CAGR of 5.33 with 34 consecutive years of dividend payment, which is really solid. Now, based off of their current shares outstanding, guys, they pay out almost $11 billion in dividends every single year. Based off of their 5-year average free cash flow, this is very tiny at $973.9 million, meaning they only have that much left after this $11 billion is paid out. However, based off of their last year's free cash flow, they're still left with $10.2 billion left. These payout ratios come out to be 52% for the last year's free cash flow and 91.85% for the 5-year average. Coming to the fundamentals, we got the net income increase of 70%, which 2 years ago during COVID, it did go negative to negative $5.5 billion. But then again, that's perfectly explainable. Free cash flow was an increase of 205% with an average of $12 billion. Again, 2 years ago, they did drop massively, but it was because of the lack of oil demand and COVID. Revenue was also an increase on the 5-year of 22.1%. Total assets minus total liabilities is rather stagnant. However, currently they have $154.56 billion with an average assets minus an average total liabilities of $146.2 billion. Cash flow minus liabilities also looking really good. Currently, they're at negative $78.5 billion with an average of negative $88.4 billion. Shares outstanding, however, is actually increasing on the 5-year at 1.44%. And from the previous year to the current year, this is another increase of 0.12%. Now, I'm actually looking at this, and this to me isn't even that bad because of the fact that, well, guys, their share price is very much overpriced, and I will be taking this into account when I make my assumptions. And lastly, when it comes to the cash and equivalents, they currently hold $12 billion with an average of $7.2 billion. So now, making some assumptions, low, medium, high, using a revenue growth of 8, 9, and 10%, and a predicted share buyback, guys, of -4, -2, and 0. The negatives means that they'll issue shares. Now, hear me out though. The reason why I think that they're going to issue shares for 2 of these assumptions is because, guys, a current share price of $180, I hope that they do not buy back shares, because buying back shares at this valuation, at this high price, it actually hurts them. So I would not be surprised if they issue shares, and at the best scenario, which would be my highest one, they wouldn't buy or issue shares, putting it at 0. Guys, these target share prices come out to be $106.68 all the way up to $118.70. And then adjusting for debt, this comes down by around $1 to $105.76 to $117.75. So the current share price of $180, guys, is telling me that it is overpriced. And as you can even see right here, I was technically buying this with a 10% margin of safety between the low and median assumption. Overall, guys, when it comes to Chevron, I love this company. This is by far my best holding so far. I was buying at a great valuation in my opinion, and I'm up $10,000 in it. So I think I did a very good investment. On top of that, they're paying me a big dividend yield of $173 per quarter. And that pretty much does it, everybody, for 4 companies that had earnings on Thursday and Friday. I will be doing a little bit more throughout this weekend. I want to take a look at McDonald's, Caterpillar, as well as AbbVie and even Next Era Energy. But for now, guys, enjoy this video. I will leave the timestamps below just so that way you guys can go to every single one. And that pretty much does it. Obviously, remember that this is not financial advice. Please do not take anything I said for real. Make your own assumptions. I have these calculators available for free for that reason. Please do not follow exactly what I am saying and make your own assumptions. And of course, remember, I will be putting in the description all of these earnings reports just so that way you guys can see it. Yeah, pretty much that's it for this video. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video as well as earnings report.